Hi PipBuddies, welcome back to the channel. Today we're going to be talking about a skill that separates the traders who feel in control from the ones who constantly feel like the market is out to get them. It's knowing whether the market is trending or ranging. Because if you don't know the difference, you're basically walking into a boxing match, not knowing if your opponent is a heavyweight or a featherweight. And trust me, your strategy needs to change depending on who you're fighting. This isn't just a nice to know skill, it's essential. Using a trend following strategy in a ranging market is like trying to surf in a swimming pool. The conditions dictate the playbook. So today we're going to be figuring out how to read them. A trend is simply the market moving consistently in one direction over time. In an uptrend, you see a series of higher highs and higher lows. In a downtrend, you see lower highs and lower lows. It's the market telling you, right now, most of the players agree on where this is going. Trends happen when buying or selling pressure dominates for an extended period. Maybe it's because of strong economic data, maybe it's a big policy change, or maybe it's just the market sentiment catching fire. Whatever the reason, the path of least resistance is clearly up or clearly down, and when you spot a healthy trend, you want to be trading in its direction, not against it. A range is the market moving sideways, bouncing between a support zone at the bottom and a resistance zone at the top. In a range, neither buyers nor sellers are strong enough to break through those boundaries for very long. Price goes up, stalls, comes back down, stalls again, and repeats the cycle. Ranges can be incredibly frustrating if you're expecting a breakout and it just doesn't happen. But they can also be goldmines for traders who know how to play them, buying at the bottom, selling at the top, and avoiding the middle where noise and false signals live. Here's the trap that catches so many traders. They identify what they think is the start of a trend, so they pile in. But the trend is really just a swing inside a larger range, and before they know it, price reverses on them. Or they try to trade a range with quick in and out moves, but the market is actually trending hard and just blasts through their levels. The wrong strategy in the wrong environment is like using winter tires in the middle of summer. You're going to be burning through your account way faster than you may think. Spotting a trend starts with looking for structure. In an uptrend, each peak should be higher than the last, and each valley should also be higher than the last. In a downtrend, the peaks keep getting lower, and so do the valleys. This staircase effect is the signature of a trend. Trends also tend to have momentum. Candles often move in the trend's direction with more conviction than they move against it. Pullbacks are shorter and weaker compared to the moves in the main direction, and if you zoom out, the overall slope of the price movement should be clearly leaning one way. A range looks like a horizontal channel. Price repeatedly touches roughly the same highs and lows without making real progress in either direction. The peaks line up near the same resistance zone, and the troughs line up near the same support zones. Ranges can form after big moves when the market is catching its breath, or they can appear during times of low volatility, when traders are waiting for new information. If you draw two horizontal lines, one across the tops and one across the bottoms, and price keeps bouncing between them, you're looking at a range. Trends happen when there's consensus. Buyers agree that price should go up, or sellers agree it should go down. The market moves with purpose because the majority is on the same side. Ranges happen when there's indecision. Half the market wants to push price higher, the other half wants to push it lower, and neither side is strong enough to win. The result is a tug of war where price just swings back and forth. Understanding the psychology is crucial because it helps you anticipate what might come next. A range often ends with a breakout when one side finally overpowers the other. A trend can slow down and turn into a range when the dominant side loses momentum. In a trend, you want to go with the flow. That means buying the dips in an uptrend or selling the rallies in a downtrend. You're looking for pullbacks to join the dominant direction, keeping your stops tight enough to protect yourself, but loose enough to avoid being shaken out by normal retracements. In a range, you want to buy near support and sell near resistance. You avoid chasing moves in the middle because that's where whipsaws happen. Your profit targets are smaller because you know price is likely to reverse before it gets too far. While price structure is king, indicators can help confirm what you're seeing. Moving averages can show you the slope and direction of a trend. If they're flat, you're probably in a range. Oscillators like RSI often work better in ranges because they can highlight overbought and oversold conditions near the boundaries. But remember, tools are there to support your analysis, not replace it. The chart itself should be your primary guide. One of the most valuable skills you can develop is spotting when the market is transitioning from a range to a trend, or from a trend to a range. When a range breaks out with strong momentum and volume, that's often the start of a trend. When a trend starts slowing down, showing shallower highs or lows and more sideways movement, it might be forming a range. Being able to recognize these transitions early can give you a huge advantage. You can position yourself ahead of the crowd and avoid getting trapped on the wrong side of the market. So there you have it. Trends and ranges are the two basic states of the market, and knowing which one you're in is half the battle. Trends reward you for riding the wave. Ranges reward you for playing the boundaries, and the fastest way to lose money is to mix up the two. In the next video, we're going to be going into the basic indicators that actually work, the ones that can help you confirm what you're seeing without drowning your chart in unnecessary noise. We'll cover moving averages, RSI, and MACD, and know how to use them like a pro. If you enjoyed this breakdown, give this video a like, drop a comment with whether you prefer trading trends or ranges, and subscribe so you don't miss out on the next lesson. Until then, keep your eyes on the structure, because the market is always telling you whether it's moving with purpose or just bouncing between its walls.